The philosophy that we utilise at Hermes is to try and benefit from the globalisation of the credit asset class. So the way that we're approaching credit is to not have lines between US and Europe and EM, or lines between investment grade and high yield and loans, and really trying to match the way that companies actually compete in the real world and the way that they borrow money in the real world. And by doing so, we think that we're better able to not just find the right company, but also access that company in the best possible way. That philosophy combines both the ability to generate dependable income and capital appreciation with a more diversified source of downside protection, ultimately leading to a better risk-adjusted return. So the outlook here is mixed. There's some parts of the market now which are I would say quite expensive, particularly in developed markets on the high yield side, and certainly in more defensive sectors. I think it's difficult to justify some of the valuations. But on the contrary, there are some very out of favour areas of the market where we do think that there is now value entering, things like the natural gas space within the energy complex, for example. And this is all in a backdrop which is generally favourable for credit, where default rates are going to be rising but off of a very low base, and the technical picture with central banks being so accommodative is likely to continue to see high demand for spread product. So being in the right areas, but I think ultimately we're still constructive going into 2020. So there's several significant risks that face fixed income going into next year. I think one of the key ones is going to be about whether central banks are able to continue to be as supportive as they have done this year, and to what extent their support has implications for inflation. And so for us, I think it's very important to try and diversify sources of downside protection, to not just rely on duration in that type of environment. So leaning much more heavily on things like country diversification and sub-asset class diversification. We think that beyond that, there's clearly risks related to equity friendliness versus debt friendliness, and we're looking at trying to avoid areas of the market that are becoming a little bit too overheated from the point of view of distributions to equity holders via dividends and share buyback programs. And obviously getting companies right at an individual granular level is core to what we do. So we're fortunate this year. We're having an extremely strong year. We're the leader in the credit space, and the performance has been driven by a whole bunch of different things. But one of the main ones has been focusing on potential fallen angels, companies that were suspected of falling from investment grade to high yield credit ratings, and really taking the other side of that story, thinking that their ability to defend themselves was much stronger than what the market was perceiving. And we've seen that quite consistently through this year. We've also seen the market being very negatively convex, with a lot of securities having an inability to participate in upside markets because of call options. So avoiding those types of pockets of the market has also been key to the type of double-digit returns that we've had. But what's also very important with a strategy like this is the downside protection element and the low volatility. The volatility around this year has been in the sort of 2 area, and again sort of best in class, particularly when you've seen pockets of more market turbulence, and that's something that we'll continue to look to achieve into next year.